Atocha Global Analytics. Please like and subscribe.
So I've recently done a video case study about commercial property and how it reacted from the really right before the great financial crisis through the great financial crisis into really the bottom of the Great Recession, and also how it will likely unfold again in the future as commercial property continues to devolve due to the high interest rates. But I referenced something in that video and I wanted to expand on that, and that's how an appraisal will work for these different properties, just based simply off of what has happened recently. So here we go. On the first slide, I show the appraisal approaches to value, how an appraiser looks at it and how a lender also looks at it. And I've given a few property types so you can kind of see. So first property type is single family. For newer homes, they care about the cost approach, but once it becomes more depreciated, it's less of a factor. The income capitalization approach, that typically doesn't apply with single family homes unless it's in an area where there's a lot of rentals. It really just depends. But the sales comparison almost always applies because it is the foundational way that market operates. Whereas something like commercial properties, whether it's office, retail, multifamily, which are the other three, with office some weight when it's new, but they're not really relying on it, whereas the income capitalization approach is typically foundational, and the sales comparison approach, sometimes it's weighted a little bit differently, but those two are the main two. Same with retail and the same with multifamily. So let's look at a 10-year old property and how that might be weighted, because the number of newer properties is limited. A lot of 10-year-old or 30-year-old properties, of course, would be at this point needing to be refinanced. So here's the likely weighting in an appraisal for these property types. So for office, cost would not be a factor with a 10-year-old property, whereas the income capitalization approach would probably be weighted somewhere between 50 and 75%. So I called it 65%. Usually the percentage is not stated. It's just more weight was given. So they give a qualitative instead of a quantitative approach there. And the sales comparison would be included. Again, it may be factors. The sales comparison may not look as good because the comps may not be close by or really as indicative as they should be. But if it's a comp right across the street and another one right down the road, it might be equally weighted. Similar thing with retail. Okay, so let's look at appraised values in 2020 when the market was hot and everything had been appreciating, etc. So the office weighting would probably still be, the 65-35 because sales comparison was going up, but the income was still also going up. So again, it may have been skewed a little bit, but this would be the typical weighting. So the appraised value on the two approaches that apply would not necessarily be the same. Let's say the sales comparison was a little higher at around 11 million and the income capitalization was about at 9.5, and rounding that out would be about $10 million. Of course, it's a little over, but they would round it. They wouldn't have 10,000 or 10,025,000 there. Okay, so retail property generally similar, and as you can see, based on that, the actual weighted value would be 9,980,000, but rounded to 10 million. So let's look at the appraised values in 2023 when the values for the income approach or via the income approach have really collapsed, primarily due to interest rates, but also capitalization rates have changed. So, and and especially in the case of office properties, the occupancy has absolutely collapsed. So the vacancy being so high, the income is way off. Retail properties, the income may be down in some markets, but in some areas the occupancy may be still maxed out, and the revenue is really strong for the property. So looking at the first property, an office property. So I basically did this where it was earning about 65% of what it had been earning, or the value via the approach was about 65% of what it had been in 2020. And let's just keep the sales comparison approach the same, and so we can show what the weighting ends up doing here. So by weighting the income approach 65% and the sales comparison 35, the weighted value is 7,863,000, which I rounded up to 8 million. Okay, so putting greatest weight to the sales comparison approach, which is still strong, it'd be 8 million. So that's 20% lower than what it had been in 2020. Though the income approach was off significantly, it didn't necessarily completely collapse the value of the property. And retail, of course, retail is much stronger right now than office. So the value is lower because cap rates have shifted, and in some places there's a little bit greater vacancy, and the revenue isn't as strong. But the value via the approaches, looking how things may have changed there, we've got 9,349,000. Because of the rounding, it comes up 9 million. If I was the appraiser doing, I would have put either 9,350,000 or I would have put 9,004,000 or something like that. So there's a quick overview of how the different approaches to value can impact the value of commercial properties in today's market.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.